Hey everyone, welcome back to Luxona, where millionaires are made. Today, we're going to be talking about Robert Kiyosaki versus Dave Ramsey, and I'm going to let you make it up to your opinion on what you think is the best. And then I'm going to tell you my opinion, which I'm sure if you've been watching my channel lately, you're going to know what my opinion is already. So here we go. So Robert Kiyosaki talks about the use of good debt, thinking like an investor, buying real estate, businesses, assets, and avoiding taxes legally. Dave Ramsey talks about getting out of debt, staying out of debt, live below your means, save and invest slowly, and using no leverage. He does not like debt. And here's the difference with, this is a big thing everyone always talks about. Good debt, bad debt, what's the best thing? And here's the thing with good debt is people use that to go buy assets like businesses and real estate. But here's the thing they don't tell you about when you go and you buy those businesses and that real estate. Number one, a lot of people think that it's passive income. When you're buying, especially with real estate, everybody right now is telling how real estate is passive. Real estate is not passive. It's everything but passive. Real estate is a job. You have to get your property managers together. You have to get your CPA, your accountant, and then you got to check up with them and make sure that they're not screwing you and making sure that everything's done the right way. Because at the end of the day, it's still up to you to get everything done the right way. So even if you have the right people in place, it's still not passive. You still have to make decisions. You have to make sure everything's going the right way. And then you have a loan on top of that. So now you got stress of paying off that loan. They don't tell you about real estate is you got property maintenance, you got insurance, you got vacancies. Not all of your tenants are going to be 100% full. You're going to have vacancies, and then you can have crashes. What if people lose their job? I had a friend, really good friend of mine. He's a business broker, been doing it for 30 years. And back in 2008, he had a bunch of real estate. He was a property developer, made a lot of money, but he utilized debt doing that. And he saw it coming. He saw that 2008 was going to happen. He even went to the banks and said, I'm worried that I'm not going to be able to pay my loans. We need to negotiate a little bit. And the bank said, no, you're fine. We're not going to. Long story short, 2008 happens. He gets everything taken away from him. Everything. At one point, he had $30 million in real estate. Nothing now. Now nothing. It's a long story. I'm going to have him on here at one point to talk about it. I'm not going to get too more into it. But long story short, my friend had everything. Lived in, the multi-million-dollar house. Drove the very expensive cars, the BMWs, the 540 series. All of that. He had the life. Multiple houses, by the way. And then 2008 happened, and being over leveraged, or he might not even been over leveraged. People lost their jobs. That's what happened during 2008. A lot of people lost their jobs, and a lot of his tenants couldn't pay. And because of that, the bank took back the properties. So, that's the thing people don't talk about when it comes to debt is all the risk that you have when it comes to debt. So Ramsey talks about getting out of debt, living below your means, saving and invest slowly, use no leverage. And that's a safe way, right? And here's the thing. When you utilize debt, your lifestyle expands too. Because you say, oh, well, I can now afford this, I can afford that, I can afford that. But you don't realize that all these payments that are coming out every month, if you didn't have any of those payments and you were investing all that money instead of it being debt, you could have been well off way more than if you used all that debt to go and buy real estate. Imagine if you paid cash for real estate. And a lot of people are going to be like, yeah, Jerry, but that's not realistic. I don't have that money. Well, debt is just instant gratification. Anyone can go and get a loan right now, right? So that's why so many people are in real estate. Anyone can get a loan. So anyone gets a loan. That's why real estate's so high. That's why the cost of everything is going sky high, because anyone with a pulse can get a loan. But it's the servicing of that debt. You service that debt, you have a monthly payment that's going away every single month. What if you had no debt at all? What if you buy real estate all cash and never had to worry about a payment? You just had to keep your reserves for your maintenance and everything else, right? Because at the end of the day, here's the thing. You still get those tax benefits for real estate if you buy it with cash or you utilize debt. And throughout 27 and a half years for a multifamily unit complex that you can write off 27 and a half years of what it costs to buy the building, here's the thing. That 27 and a half years that you get that benefit, it ends up being like 3.5% per year or whatever of the cost of the property. So you get that tax shield. But here's the thing, that 3.5% is supposed to go towards maintenance. That is not for you. That is for maintenance, for when a refrigerator breaks, for when AC units break. And a lot of people think, oh, I get all this tax breaks and I'm just gonna go grab that money and I'm just gonna go buy a brand new fucking car. And then they wonder why, a year or two later when a AC unit breaks and it costs $30,000, they don't have any money. And now you're broke. So now you have debt, you owe $30,000 on an AC unit, and now you're broke. And you have debt, and now you're screwed. You're in a bad position. So yeah, you're like, well, I used 20% to get 80% on this property, but now that 20% is going to go to waste anyways, because now you're going to go in bankruptcy because you did not utilize that money correctly. And the thing is, Robert Kiyosaki talks to the 1%, but the average person listens to him. Only 1% of these people actually make it, survive, and do good with debt. That's why debt for normal people are not good. I mean, look at 2008. Look at all those people that lost everything in 2008. Bear Stearns, all the sophisticated investors. I always hear, oh, sophisticated investors. Well, guess what? They all lost everything in 2008 too. You know who didn't lose everything in 2008? The people like Warren Buffett. Warren Buffett doesn't use debt. The biggest, best investor on the planet Earth never uses debt. He doesn't even buy real estate. So think about that one. And here we go. So the success rate, statistics now. Less than 2% actually get rich with Robert Kiyosaki. Most of it motivates you, which is good. I appreciate Robert Kiyosaki for what he teaches because we need more financial education in the United States and worldwide. Right now, we have the least financially educated people here in the US. We are in the information age and we have the least financially educated. So I appreciate everything he does. Even though I don't agree with everything he talks about, it still works for some people. It motivates people to get to where they need to be. And Dave Ramsey, though, has a 10 to 20% debt-free success rate. 10 to 20% success rate because what he does works. It's scientifically actually proven because money is behavior-based. It doesn't have to make sense mathematically all the time because it's behavior-based. That's why when you use debt, you're statistically more likely to go into more debt and to waste money and go and buy things you can't afford because you're using debt. And you think you're being smart by the word arbitrage and going and buying real estate to pay for that debt. Meanwhile, you're going in more and more and more debt because you think you can afford things till one day you wake up and you're like, oh shit, I'm broke. And he has proven things. He has the baby steps he talks about. He talks about emotional wins. No risk, no stress. Wealth through discipline. A lot of people use debt for instant gratification. In my opinion, debt is instant gratification. So that's why so many people love listening to Robert Kiyosaki because they're like, oh my God, I can use debt. I can go buy this big building. I can get investors and I can become a millionaire. It's not that easy, guys. And it's not passive. If you want true passive income, you invest in the S&P 500 or you in real estate. If you want to get real estate exposure, you invest in REITs. That's truly passive. The market is truly passive, but you can't control it like Robert Kiyosaki wants to control real estate. A lot of real estate guys, they want to control it. That's what they do. That's their passion, and that's why it works for them. Now, if you're trying to get rich quick, you're going to fail. Don't try to get rich quick because at the end of the day, it all comes down to energy too. Money is energy. If you want to get rich quick, you're in the lack state of mind. That is why when you go and utilize that debt, you're going to be broke because you're not in the positive mindset for growing wealth. You're in the I am in a lack state of mind of wealth and I want to get rich quick. So I hear this, I get motivated, and then I think it's easy because everybody thinks it's so easy, and I want to go out and get all this debt, and I want to get investors, and the next thing you know, you're not going to just hurt yourself when you do that. You're going to hurt your friends and your investors that you took that money. When people talk about other people's money, don't take that lightly. Do not take that lightly. You're using other people's money. If you screw up, you are hurting not just yourself, you're hurting those people that gave you their money, and that'll fuck up relationships with you too. And then here we go again. So book sales, 40 plus million sold with Robert Kiyosaki and 25 plus million with Dave Ramsey. And then with courses and students, you don't have any stats on Robert Kiyosaki, but we have stats on Dave Ramsey. He's got 10 million. So now we're going to talk about Warren Buffett. Most of my stuff I learned too is from Warren Buffett. I love Warren Buffett. He's amazing. So Warren Buffett, again, like I said before, he doesn't invest in real estate. He has no personal debt. He buys great businesses. So he'll buy great businesses that are already cash flowing. So businesses, he gets it on a deal. Whenever you buy things, you make your money when you purchase it. If you get it for a good deal when you purchase, that's where you make most of your money. A lot of people in real estate will be like, it's all about cash flow. This is true. But if you buy the real estate at the lower price than what it's actually worth, that's how you make most of your money in the first place. And then long-term compounding. He talks about never sell anything. Buy and hold forever. That's how it should be with real estate. If you're trying to invest in real estate, you should buy and hold forever, because so many people that sold their properties because of COVID, it's sky high now, and now they can't even go into the market and buy it, and now interest rates are so high. So it's very hard to get in real estate right now. Very, very hard. Unless you've been in real estate for a long time, you're good now. And if you've held those properties, you're way, way better off. And now you're making all this cash flow on top of it, plus the appreciation. So when you buy real estate or you buy anything, real estate, businesses, or index funds, or anything stock-wise, hold it forever, never sell. That's how you build true wealth. So who actually wins? I mean, I kind of already explained it, but so with Dave Ramsey, he's safe. Robert Kiyosaki's risky, and Robert Kiyosaki says this too. I mean, he's not lying to you guys. I do like Robert Kiyosaki, and he really is educating people, and I love what he's doing. And we need more people like him, but he's more risky, and he's for professionals. Only 1% of people that do what Robert Kiyosaki succeeds. Because again, it's very hard to succeed with debt, because a lot of people utilize it, over leverage it, because we're human beings. Look at 2008. You know how 2008 happened? Because everybody got happy on easy money. Look at COVID. Everybody got happy on easy money. A lot of people screwed themselves. A lot of people made a lot of money. The smart people made a lot of money, but the dumb people hurt themselves. And what's the outcome rate? With Dave Ramsey, his outcome rate is 10 to 20%. With Robert Kiyosaki, it's low, it's 2%. And with the tools, his is mainly mindset. He teaches a lot. I'm not dogging on him too much. He teaches a lot. I love what he does. I listen to Robert Kiyosaki as well. But most of it is mindset. A lot of these guys talk about mindset, and he does teach financial education, but he teaches it for more of your professionals. But the problem is, a lot of normal people, everyday average people, listen to him and they think that they're going to go out and become a millionaire, when in reality there's a lot more to doing and utilizing debt. That's why Dave Ramsey talks to your average person and says no debt. All debt's bad, because your average person cannot use debt correctly. Only 1% of the people in the world can utilize debt correctly. That is fact. Only 1%. It's very hard. A lot of people don't know how to do it. They don't have the discipline, and it's very hard. And Dave Ramsey has a full system on how to do it. Robert Kiyosaki is more advanced. So he's got very advanced. Tools is mindset only here, and full system here with Dave Ramsey. He has a full system, baby steps, tells you exactly how to do it. I did it. I'm debt free. I got my 6 months emergency fund. I'm putting away 15% right now, every single paycheck, towards the S&P 500. That's what I do. I got 6 months savings. I'm doing great. And only 13% of people in the United States are out of debt. Think about that. Only 13% of people in the United States are out of debt. And the target is everybody. He targets everybody. And then Robert Kiyosaki targets advanced people. So Robert Kiyosaki is for the highly advanced people, the 1%, right? But here's the thing. The 1% aren't listening to Robert Kiyosaki. They're already doing it. They don't listen to him. They're already doing what they're doing. The 1% don't listen to this stuff. They're not going to listen to what I'm talking about because they're already doing what they're doing. The highly advanced people that are very successful, they've been doing this for a long time. They've had mentors. It's family. They know what they're doing. They've been doing it. They're not watching YouTube videos like this. But Dave Ramsey is for everybody. So Dave Ramsey wins, in my opinion, because most people are not good with their debt. That is a fact, guys. Because the second you get debt, instant gratification, you want to go get that car. Oh, there you go. Go get that brand new car. Go get that brand new house. But here's the other thing. Your house also is not an investment. Your house should be for your family, for yourself, to be in a good school district or whatever else, other reasons you want that to be, but it's not an investment. Things that are investments are things that make you money. A house is not making you money. It's not paying you every single month. Every month, money's going out of that house, guys. Okay, you got maintenance, you got property taxes. The average person ends up putting like over $100,000 into their house over the lifetime of that house. And then maintenance in general is 1% of the purchase price of that house. And then when you're using debt to buy that house, especially right now, it's 7% interest rates, you go buy a $400,000 house, the house is going to end up costing you $1.2 million by the end of the 30 years. So that $400,000 house is now $1.2 million. It's going to cost you. And then the average house, long-term price, appreciates 4% a year. So if you're buying a house at 7% interest rate now, and the average long-term appreciation of a house is 4%, you're losing 3% a year just on the debt that you use to buy that house. And I get it. A lot of people use debt to purchase a house because, you have that equity. I understand that. And then because it's more of a forced savings account, because most people will just rent and then waste the rest of that money. The difference that they would save by not owning a house, they would waste that money anyways. That's why Dave Ramsey likes for you to purchase a house even using debt, because that's like a forced savings account. Because then, let's say you go to retire, you can sell your house, put the rest in the market if you don't have a pot to piss in, and then you could rent anyways, which you'll end up renting anyways. Or you can buy a lower cost house, and downsize, and then you can put the difference in the market. So, there you go. Who wins? My opinion, Dave Ramsey does. I explained that to you. I want you guys to comment below what your opinions are, what you think. I want you also tell me if I should do more face, because I'm doing my faceless channel, but maybe I'll do more face of me, talking, explaining these things, so you can have that connection with me and you know what I'm talking about, and I'm not just some person, just using AI and whatnot. And I also have another friend I'm going to be interviewing. I have a lot of friends that are very wealthy, so I'm going to be interviewing another friend who sold his business for 7 figures. Probably next week, I want to start maybe doing interviews like that with successful people once a week. And then I'm going to interview my other friend that I told you about, the 2008 crash. I'm going to interview him. So again, welcome to Luxona. This is my brand now. This is what I'm doing. I'd like to do this full time. I'm going to keep doing this because I think financial education is the best thing in the world. And I think people need to be educated financially, and they'll be way better off and less stressed out. And especially in this day and age, we need to be educated financially. Again, welcome back to Luxona, where millionaires are made.